Global markets are mixed ahead of big US and Japanese rates decisions later this week. US retail sales are solid. New Zealand's government announces a bigger-than-expected increase in bond issuance, and Australian consumers end the year better off. That's coming up in our 5 Things in 5 Minutes. And then for our final bonus deep dive interview of the year, ANZ's Group Chief Economist Richard Yetsenga looks at the key themes of 2024 and what 2025 might bring for the global economy.
Stuff is going to happen. I think Trump will be more disruptive than destructive. The detail of his policies is going to matter quite a lot to where that disruption shows up.
But first, in 5 and 5 with ANZ, global stocks fell slightly and bond yields fell overnight after US retail sales were stronger than expected. Although the underlying picture was softer and gave some reassurance, the Fed can still cut tomorrow. Here's ANZ economist Bansi Madhavani talking from London.
The retail sales spending data at the start of holiday season showed a rebound. GDP Now estimates show that the economy is on track to grow over 3% in the fourth quarter of the year. In such a scenario, we expect the FOMC will guide that it may begin to slow the pace of its easing. It is likely that the Fed revises both its growth and inflation forecasts higher for 2025.
As of 4 a.m. Sydney-Melbourne time, the S&P 500 and the Nasdaq were down around 0.3%. The US 10-year Treasury yield was down 1 basis point at 4.37%, and the US dollar index was flat. The Aussie dollar, though, was down 0.5% at a one-year low of 63.38 US cents, while the Kiwi was down 0.41% at a two-year low of 57.57 US cents. Number 2. The other big interest rate decision this week is the Bank of Japan late on Thursday. ANZ FX analyst Felix Ryan is expecting a 25 basis point hike to 0.5%. Felix says the BoJ has indicated a data-dependent approach as it looked to normalise rates up towards 1%.
CPI services growth in both the Tokyo CPI and the national CPI have been quite firm. We've seen PPI services as well hold near multi-decade highs too, and that's quite a good indication of further service pressures on that front too. It did highlight business sentiment approaching a 3-decade high too. That does suggest some indications of further business capital expenditure coming in the future as well. So overall, that data there really does lead us to think that the Bank of Japan will be tightening rates.
Number 3. ANZ Roy Morgan Australian consumer confidence finished the year down 1.6 points at 83.9, as the time to buy, a major household item sub-index, fell 7.9 points after Black Friday sales ended. ANZ economist Maddie Dunk says that the rise in the index from 77 mid-year, though, means the Australian consumer ends the year better off.
We've seen this slow grind upwards in consumer confidence. People are feeling a bit better about their personal finances in particular, but also the broader economic outlook. And I think that largely reflects those stage 3 tax cuts, which have been in effect since July. There's also been cost of living support. And the other thing too is that inflation is continuing to moderate. So that's helping households feel a bit better about the economy.
Number 4. Downward revisions to official growth forecasts and a lower forecast tax take have led the New Zealand Treasury to increase its bond issuance plan by a much more than expected $20 billion over the next 4 years. ANZ senior economist Miles Workman says the higher borrowing might not move the dial for monetary policy, however.
What we're really seeing here is a weaker economy and a few assumption changes causing wider for longer fiscal deficits, which it does look like a more expansionary fiscal impulse than previously, but I would heavily discount that given the simple fact that it's driven by these economic drivers, automatic stabilizers, so weaker economy, weaker taxes, and higher spending on benefits, for example.
Number 5. There's some light at the end of the tunnel for New Zealand's housing market, though, as prices rose 0.2% in November, according to the Real Estate Institute. ANZ economist Henry Russell says prices look set to rise 6% in 2025, off recent stabilisation.
Obviously, the current economic conditions still remain very soft, and the labour market is still adjusting to past weakness in the economy. So until the labour market stabilises, which we expect to occur in the middle of next year, that's likely to be a bit of a handbrake on the recovery until we see a meaningful upward. We don't expect to see a meaningful upward swing in prices until the second half of 2025.
Henry Russell there. Now, in my final bonus deep dive interview of the year, ANZ Group Chief Economist Richard Yetsenga discusses the major themes of 2024 and what he expects to see in 2025.
I think that interest rate purgatory beige, which I think is what a mid-cycle slowdown always looks like. They're always frustratingly kind of low trend. There is a trend to lower rates, but it's not linear, it's not broad, it's not highly correlated, and it's not aggressive. That's probably the dominant theme for me.
Why do you think it is that way? Because you're right, a lot of people thought this was going to be the year of rate cuts and everyone was going to be cut, and here we go.
People love a cycle, and people love the Mount Kilimanjaro cycle. Something goes up a lot and then it will go down a lot, and it will be exciting and it will be a ride. And it clearly doesn't always work that way. We've had a regime shift around things. And maybe the second big theme for me for the year was that economic resilience story. Global economy still growing above 3. Remember, there was talk about a global recession, which is often defined as global GDP growth below population growth. Global population growth is about 1. So the global economy growing a bit above 3, miles away from global recession. I think that's the second thing. This underlying resilience, even with the level of interest rates in many economies at multi-year highs.
So looking into 2025, what is the chance of recession? What's going to be the major factor there?
I don't think anything's changed from 2024, 23, 22 to 21. Private sector balance sheets in general are still in very good shape. The proximate driver to me is this 15-year shift in global financial sector regulation. If banks hold a lot more capital so can withstand greater losses, if they're also lending to customers that are on average more creditworthy, they should actually suffer fewer losses and then have this greater buffer to deal with them. Economies are going to handle higher rates in better shape and in fact be more responsive as rates come down a little bit. I don't think for most businesses and most of us, I don't think insufficient demand is going to be 2025's problem. There's a couple of sectors where it will be. Consumer discretionary as a general thing has been a bit of a tough space and probably remains a tough space. But in many parts of the economy, I think the main issue is access to resources, access to labour at a price which allows you to be profitable.
So geopolitics is something we have to worry about all the time now. One of the big events in 2024 was Donald Trump's re-election. Why do you think 2025 and the Trump presidency, why could it be more disruptive rather than destructive?
Well, I think that's a call we have to make, really. To what extent do you think Trump is going to fundamentally readjust things in such a way that we end up with some very serious side effects, or actually are the impacts of his policies likely to be something that we can work through, even if they do at least throw a couple of apples out of the apple cart? And maybe to step back for a moment, 2024's year of elections certainly delivered in 2024. Clearly the effect of that is carrying over into 2025, because what we've seen in the year is this vote against the incumbent. It's been less about left or right or particular policy pitches and more just about voters being unhappy with whoever held the reins of power. So that gives, where there's swings like we've seen in the US, where we have new governments that have a reasonable mandate given the share of the vote they've received, stuff is going to happen. I think Trump will be more disruptive than destructive. The detail of his policies is going to matter quite a lot to where that disruption shows up.
And China's one of these stories we watch and wait for a big stimulus and some sort of takeoff, but 2025, tell us about that China stimulus. What's it really like?
Well, on one level, there has been a lot of policy action. Almost any government agency in China you care to name, and some you've probably never heard of, have made announcements that you would say are part of this package. And I use the term package loosely because it doesn't seem like there's been a puppet master for the package. Certainly there's been no announced overall narrative. But from late September, each of the agencies, Ministry of Commerce, the agency that looks after the housing sector in China, more effort around urbanization. The central bank has cut interest rates and made some changes in its liquidity facilities. The banking regulator has made changes. So there's clearly a package here. My judgment, though, is this is designed to shore up the foundations for growth, improve balance sheets, and get things in the economy back towards a more stable footing, rather than trying to spark some aggressive ups in GDP growth.
Richard Yetsenga there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, December the 18th, our final 5 and 5 with ANZ for 2024. Look out for us next year, starting Monday, the 13th of January. Merry Christmas, everyone. Well, as we say here in Aotearoa, New Zealand, Meri Kiremiti. And we wish you all a safe and prosperous new year. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.